Hello everyone. My name is Gabriel Stein. I'm Director Asset Management Services at Oxford Economics. Welcome to the latest in our series of irregular podcasts on irregular topics. I'm sitting here with Michael Taylor, one of our lead economists, and we're going to talk about quantitative tightening, a term which recently has become the topic du jour of some of the economic commentariat. It stands to reason that this is going to be perhaps quite a technical discussion, but we will do what we can to keep it on a general level. Michael, so quantitative tightening as loosely defined in some of the writings that have been published recently by other economists, it goes more or less like this. The Fed and possibly the Bank of England, but above all the Fed, is going to raise interest rates. That means that US assets become more attractive, and capital that previously flowed to emerging markets will now flow back to the United States. The monetary authorities in those emerging markets don't want capital to leave because it means weaker currencies. They will therefore sell assets to prop up their currencies, and the assets they sell will be their foreign exchange reserves, primarily dollars. And when they do that, they drain liquidity from their own economies. In other words, if the People's Bank of China were to sell dollars to prop up the RMB, the stock of RMB in the economy will diminish, and so we have a tightening impact, and this is therefore quantitative tightening. Do you agree that this is a sound definition?
No, in a word. I mean, I think clearly quantitative tightening is, as you say, is being used as a rather loose definition. I think it's very important to keep in mind a true definition of quantitative tightening, which is the sale of assets by central banks as a policy of essentially reversal of the quantitative easing that they have done in previous years. So they are selling back usually government bonds that they bought during the process of quantitative easing back into the market. And the initial first round effect of that, of course, is to drain liquidity from the relevant market because they're taking in cash and giving back government bonds. But then clearly there are other second and third round effects to take into account as well. But that is the essential definition of quantitative tightening.
For instance, if the Federal Reserve were to sell bonds, so the issuers of those bonds have to redeem them. But of course, if they need to borrow again and they go to banks to borrow, then they neutralize the impact of in the second round, they will neutralize the impact.
Exactly. Now the banking system is, generally working reasonably well again. Clearly, a lot of quantitative easing was originally done because the credit creation system had broken down. Now it is working again, clearly, especially in the US. Economic agents can go to banks, borrow money, and as we all know, the creation of credit creates money deposits, and the initial negative effect is offset.
Yeah. Now, but that, of course, is something that an emerging market central bank can't do. They sell their dollar reserves to buy their own currency, and so they do drain liquidity from the economy. I suppose they could attempt to neutralize it by, for instance, buying assets, in other words, by engaging in their own quantitative easing domestically. But that is presumably not such a good idea because that could raise inflation fears and worries that the currency would depreciate, and so you have a vicious circle starting.
Yes, I think for less developed economies it is more difficult because clearly they don't have the institutional structure. So even if they wanted to do quantitative easing, the sort of the nature and the quality of assets that a central bank could buy would be perhaps clearly more questionable than when the Federal Reserve or the Bank of England engage in such activities. So I think it is much more difficult for emerging markets, and clearly at the moment there is this sense that capital is flowing out of emerging markets back into or towards the developed world, But that isn't the essence of quantitative tightening. That's just capital flows which obviously happened before quantitative easing and will happen again in the future when we've all stopped talking about quantitative easing and quantitative tightening.
Yeah, I think that's the key point you're making. Quantitative easing was a deliberate policy on behalf of a number of central banks to loosen monetary conditions at home or globally. Quantitative tightening, as you said initially, properly defined, would be the reversal of that by those same central banks, or for that matter, from a global perspective, perhaps by other central banks. But this is not what people are talking about here. What people are talking about here is a side effect which crucially assumes that emerging markets, in this case monetary authorities, really want to stop their currency from falling. That raises the question, of course, why would they necessarily want to do that? Would not a weaker currency have two attractions, a competitive advantage and potentially being inflationary in a world where the lack of inflation is seen as a problem?
Indeed. I mean, it may well be that in this world of, we've seen sort of developed economies engaging in competitive devaluations, that the emerging world does the same. But I mean, clearly there's a limit to the net total of world trade isn't increased by changes in exchange rates. So it is a zero sum game, and in many cases, emerging markets are obviously trying to establish anti-inflation and general monetary policy credibility, which, if they allow their currencies to fall too far too fast, would clearly be put in jeopardy.
True, of course, and there's of course another point, which is if they have borrowed in foreign currency just as such, it becomes more expensive to repay, and also if they have borrowed in foreign currency using domestic collateral, which was worth one thing when the exchange rate was propped up, and all of a sudden if the exchange rate drops, the collateral is worth less. So there's a problem, you have to put up more collateral, but to do that you need to borrow more, but you can't borrow more. So, however, there is another problem here. We saw in the Asian crisis and in the Russian crisis, both of them in the 1990s, 97 and 98, that a lack of large enough foreign exchange reserves meant that countries could not really defend their currencies properly. We had Korea, we had Thailand, we had Russia, and so on. However, that situation has of course changed. One thing that the Asian crisis in particular led to was a deliberate policy on behalf of, in particular, Asian countries to build up large-scale foreign exchange reserves. Does that mean that they can now better defend their currencies?
Well, I mean, actually, obviously, what is also different now is that there are still some fixed exchange rates, but there are fewer fixed exchange rates which were attempting to be defended last time. This time, in a freely floating or a floating environment, it's less of a crucial thing to sort of defend your currency. But given that a lot of it's only, as I understand it, a relatively small proportion of reserves which are now readily available for defending the currencies. And
why is that? Why is only a small proportion available?
Well, I guess there's probably the buffer argument. Countries want to retain a large stock of foreign currency reserves. And I think it's perhaps the lessons of history that, however, you might start with a large stock of foreign exchange reserves, but if you're forever defending or trying to prop up a falling currency, then you rapidly run out of reserves no matter where you start from, as indeed the Bank of England discovered in 1992. It's defending a currency with foreign currency reserves is something to be done sparingly and in a limited fashion. I think that's sort of been the lesson of monetary history since the Bretton Woods system fell apart.
So essentially, all right, you've built up these huge FX reserves in East Asia, notably China with its close to 4 trillion, but it doesn't matter because you can't you can't really use them to defend the currency. And if you really use them to defend the currency, everyone would say, oh God, that they're throwing everything to defend the currency, and that means they will run out of money soon enough.
Foreign currency reserves obviously can be used for other purposes, but not. I think it has become a lot more difficult to use them for the purposes of propping up a currency.
I think one on this is slightly digression from this topic, but I think one of the comments I read a couple of years ago was that actually the point with foreign currency reserves nowadays is, if necessary, to intervene in your domestic asset markets and prop up asset prices instead.
Indeed, yes, as may well be happening or has happened in China.
And in the past in places like Hong Kong and so on as well.
Yes.
There's another thing I would like to go back to. I mean, I think what we're saying really is this. There can be a specific individual countries can have a problem with capital flows, but it shouldn't be dignified by the term quantitative tightening, but because they had it before and they might have it in the future. But on a global basis, surely if an emerging country sells dollars to prop up its own currency, so you drain liquidity from their own economy, but on the other hand, the dollars that they previously owned are they released into the world economy, or were they part of the world economy anyway? In other words, is the impact actually on a global basis neutralized?
Yes, I believe may well be. Those dollar assets may well find themselves through various routes back, for example, back to the United States, where somebody sells an asset and or buys an asset, and money is deposited into the banking system. And the bank and that bank may actually buy U.S. Treasuries, which was the asset that was originally sold. So yes, I mean obviously all sorts of arguments about the marginal propensity to consume, etc., in different economies and how these assets might be used. But the net amount of global liquidity is little changed, or indeed not changed at all.
So to sum up, therefore, quantitative tightening, an attempt to find a catchy phrase to describe capital outflows, which are the result of previous capital inflows, and actually much of a storm in a teacup.
Yes, until obviously we do actually get proper quantitative tightening, which is when the Federal Reserve and the Bank of England, and maybe one day, very far in the future, the Bank of Japan sell the assets they've bought. That would be quantitative tightening.
That would be quantitative tightening with a vengeance. Actually, I will mention it here. I am actually going to write a value of money research briefing on this particular issue within the next couple of weeks. So I'm sure we'll come back to that. Meanwhile, thank you everyone for listening, and there will be further podcasts on different topics in the future.